Hey, everybody. Welcome to this week's halftime show here on StockCharts TV. I'm Pete Carmasino, Chief Market Strategist at Chaikin Analytics. And we do this each and every week, kind of go over the markets and just talk about what we're seeing here, sort of from a macro view. I mean, look, markets are in a downtrend. The path of least resistance is lower. There are some areas of the market that are worth looking at. But, where we are now is a fight between short-term interest rates and taking risk in the market. And in some cases, in many respects, that's considered a risk-off environment. Risk-off meaning that it's not really the time, maybe not the period of the market cycle to take too much risk. Should be ratcheting it down. So risk-off means just taking some money or taking less risk or taking some money off the table, depending upon your risk tolerance and your goals. If you're a young investor starting out, look, dollar cost averaging and time is on your side. If you're in the middle of that time frame and you're concerned, you can take a small percentage down and adjust that as it goes. But there are different ways to run this process. We're not here to tell you how to make asset allocation decisions, but when we use those words and that terminology, I want you to understand that that's what we're talking about. It's not as if it's all in, all out, moving everything back to growth and out of value. And no one really does that. It's sort of a migration in and out of risk. I mean, you can use the simple 200-day moving average. It's sort of been tested and beaten and, beaten into our heads over the years, I should say. And people have just said, look, there's a long-term trend now. Depending upon if that long-term moving average is rising or falling, there are some nuances to those things. And so even our own rating has that little technical overlay in it as well when we're looking at our ratings changing. So when our ratings change from, bullish or bearish, and in between, which we have what's called a neutral positive, which means it's a bullish stock that's starting to break down, or neutral negative, which means it's a bearish stock that's starting to break up, going higher, right? Reversing its trend for some reason on a technical basis. Fundamentals haven't changed, but if the technicals start to, we want to be alerted to it. So that's when you see those changes in our rating, that's what that means. I just want to make sure everyone is aware of that. But, just looking at today's market, I mean, we're just seeing everything kind of lower, not too bad, not as bad as the start of the day. I'm filming this midday here. So they're mostly lower, but again, off their worst levels, that's for sure. Again, the path of least resistance in this last week has been, to the downside. And we're going to go over a few different things here today. I'm going to go over a lot more charts from a macro view today, and then we'll dive in and take a look at just one or two names that could be still under pressure and considered from a relative strength standpoint breaking down. So let's dive in and see what we can see today. Okay, you've been following me hopefully now for a little bit more than a year, and some of you might be subscribers and some of you may not. But we do a lot of different areas of content creation, right? We do this video, obviously. We put out blogs on something called the Chaikin Power Feed. It's chaikinpowerfeed.com. And I'm just going to pull up the one that I wrote last week. And it's talking just about inflation and recession and how that kind of works and how it plays out. But specifically, you can go and read the article. I'm not going to read it here word for word. What I just wanted to point out was if you go back and look at the CPI versus the Fed funds rate back in the late 70s into the early 80s here, what are you seeing? The CPI is the orange line. The Fed funds rate is the blue line. You're seeing that Fed funds rate has to move higher. Now, this area where the CPI is falling and the Fed funds rate is rising is kind of what we're starting to see. We're not there yet. Are we seeing peak inflation? No. Please remember this. Peak inflation does not mean low inflation, right? People are saying it all day on different mediums and different parts of the mainstream media, notes, podcasts, Twitter spaces, it's everywhere. But that's the narrative. Remember, peak inflation does not mean low inflation. That's still a headwind. And that means that the Fed funds rate has to get higher, all right, above potentially that CPI level. Here we are now. CPI ratcheted higher and ran. And now the Fed funds is here. We're talking about a rate hike here Wednesday, right? And it's probably going to be a hike, most likely 75 basis points. And even if that happens, that's about 2.5, call it 2.3 if you squint. Maybe that gets us to 305 to 310. That would mean at this level currently here on Monday that the Fed funds rate would need to double And the CPI at 8.3, we need to get cut in half, right, for it to be inverted, meaning for the Fed funds rate to be higher than CPI. That would be amazing if we saw a CPI fall 4.1%, 4.2% in a few months. I don't know if it's possible, to be honest. I really don't know. But the gist of the article was that if rate hikes cause recessions, then recessions end rate hikes, right? I mean, I'm just backing it back, looking at the math backwards and saying, well, if that's the case, that's the case. But my point being is, here's what it looked like in the early 80s. Here's where we are today. We're chasing it, right? The Fed's trying to do what it can, but I just don't see things materializing that fast. Okay, I know the video covers part of this. So I apologize for that, but it just says Wednesday's Fed meeting is the focus. And this is really the most anticipated Fed meeting since the last one. And I mean, I'm saying that as a joke, but at the same time, it's also true because it seems like every Fed meeting is the best meeting to listen to or the most important one. I think all of them are. We're in a quiet period, so enjoy that time where the Fed's not speaking every day from every angle and corner of the world. And that's kind of nice too. But look, the fact is that the Fed's dictating markets because they're dictating rates, right? And markets are reacting, and they are the collateral damage as part of this. I mean, we knew this going into this year. We talked about this many, many times about when rates are rising, right? It's going to affect assets, long-dated assets. We have an inverted yield curve today, right? You're talking about 6-month treasuries getting close to 4%. People are talking about the 2-year, the 6-month and 1 year are almost there. So pay attention to that because that's in the fabric of financial models. They're looking at 1-year risk rates, risk-free rates of return, right? Meaning they compare the growth rate of a stock, whatever stock it is. It could be the biggest blue chip to the newest tech company out there. The point being is that you have to have some multiple of the risk-free rate. When the risk-free rate was 0.2, it was easy to beat 3 times or 4 times the rate. Now you're talking about 3 times the rate today could mean 12%. That's hard, even at 2 times. That's an incredible feat of growth in a current market that's raising rates where FedEx reports and the CEO says we could see a worldwide recession. Don't take my word for it. Don't take anybody's word for it. Just watch the tape and see what's going on. Short-term rates will tell you what's going on. That's what's happening. So speculation suggests, obviously, that short-term price falls are valuable. That's not always the case, okay? Let's not confuse a low price for high value. We know that. We know that in all the goods we buy. We know that in the technology from automobiles or food or clothing in general. We know that some stuff has higher quality than other things. We know that there are some high-end stores that you'd never see located next to a low-end store for whatever reason. There's an image behind it, but there is a quality to it. So you have to basically, I don't know why people forget that in the market. Let's not run in and specifically hone in on 1 or 2 names. I like the idea, don't get me wrong, of dollar cost averaging into an index and potentially a basket of bigger names, right? It could be a thematic basket if you want it to be all in tech or something like that. You're taking more risk doing that, but you have to really judge it for yourself. But overall, yes, of course, you want to try to dollar cost average into lower prices to get better value over time. It doesn't mean you're getting something that's worth $100 and you're paying 10 for it. That's just typically not the case. So I think we just tend to forget that. I wanted to point it out. A little tough love here as a reminder. Just looking at the indexes, you can see everything's kind of rolling over here. There's no doubt. S&P is up here where the blue arrow is, but there's your industrials, your materials. I like to look at those in comparison to the defensives, which are your healthcare and your utilities. Even utilities have really turned the corner here and fallen and come back in a little bit because, look, I think now utilities provided a dividend and some growth. There's no doubt this year they were one of the top performing sectors, but now they're even being threatened by short-term rates. Meaning, when I mean threatened, I mean they're in competition with short-term rates and losing, and that's what I mean. So people are saying, all right, I can buy a 6-month T-bill and sit this one out. and wait for the music to change before I get back in, back on the dance floor, right? That's just kind of the way the investors think. August 22nd, we looked at the pattern here. We saw it hit 4,300. I want to point something out. 4,300 happened to be the 200-day moving average. It also was the neckline of our head and shoulders pattern. So I think that's important to look at. There's the 12th, and we saw it rally back to 4,100, and then a swift return back to the downward trend. You got to be careful with that. And this is really the chart I like to basically look at. You're looking at the bullish percent over a weekly basis of the three composites. I got S&P down here at the bottom. You see 2 weeks of negative. I got the NASDAQ in the middle, 2 weeks of negative. And I've got the New York composite, which is a pretty big composite of stocks, also 2 weeks to the negative side. So we are in a sort of a bullish percent that's telling us and signaling that not a lot of stocks are showing bullish activity at this point. We talked about rallies. We're in the third rally. They're averaging about 13%. Looking at the FANG index, this was today's. We're back at around that 5,100 level, trying to stem the losses, but it looks like this area here, really at this line, which I would assume is about 5,000, is probably going to be support. If we get below there, we might be hitting that pre-pandemic high. You're looking at sentiment changes, but staying below the historical levels of 38. We're only at 26 on the bulls, and we're way above on the bears as well, between 30 on the historical and 46 in the current level. Looking at TLT, this was back in June. We were talking about this at 110. Middle of June, it popped higher at 112. Then it went back to 110, right? Back on that June. The 15th, it rallied all the way to about 120 or so, just underneath of that. And we were talking about it being overbought and a negative divergence. And so now what do we see? We're back below 110. Why? Because rates are rising, and rates, when bond prices fall, rates go higher. That's how they adjust in the market. That's what happens. The SPY back in June 17th, we were talking about a 375 target. July 15th, we had Hardy hitting it. You're talking about August 1st here, right back to that 410 level. Again, this is our charts. And then back here, we again kind of meandered around that 410, couldn't quite get above it. How about this? 3 lower highs in a row, at least 3 lower lows right here. And potentially we might be testing this area and probably getting back to the lows if it breaks, right? That's basically it. The Qs, kind of the same pattern, right, that we drew out again on August 1st, rallied all the way back to our resistance line that we have been drawing now for months. And then, of course, this is today. I forgot to change the date. Sorry about that. And that's kind of where we are right now at around that 289, 290 roughly level. All right, I'm back here to the Chaikin system, and I'm just going to call out some names that are changing to the downside here. And, just concerned looking at names like this is a coal company, and you're seeing that trying to sort of change relative strength. And a couple of names here, like a chemical company. It's like CC here is the symbol. This is the Chemours chemical company. It's kind of been a flat line here, but it's something to kind of pay attention to. And there was one more here. Honeywell was a big name, right? Big cap, obviously cyclical, industrial type conglomerate company. But again, fighting itself here back and forth between and above and below its long-term trend. It is bearish. The trend is negative. It is a weak trend in a stock that's in a weak industry and actually changing relative strength to the downside. So just pay attention to some of those names and look for those ratings as they change. All right, everybody, that's all we have for today. I appreciate you tuning in, and I know I took a lot of time here looking at some different charts, but you can follow me on Twitter, but we'll be here every week here on the Halftime Show on StockCharts TV. Thanks again for tuning in. We'll see you real soon.